What if you could buy an investment property and then turn around and sell it for a profit and not pay any tax on the gains you made? What if you could take that gain, avoid paying any taxes, and then go out and use that gain to purchase another investment property? What if this was perfectly legal to do? Well, that's the subject of today's video, and we're going to get started right now. This is not tax advice, and you should seek out the guidance of a professional tax advisor. My name is David Matney with Nebraska Realty, and I'm a local realtor here in Omaha, Nebraska. Now, if you enjoyed today's content, be sure to subscribe to the channel and ring the bell for notifications. If you like the idea of building wealth while minimizing your tax burden, be sure to give this video a thumbs up. And let's jump into today's topic. This is not a short-term strategy for someone who is flipping homes. This is an investment strategy for investors who buy and hold investment property for over a year. One of the benefits of investing in real estate is a thing called depreciation. The federal government allows you to depreciate a residential investment property over a 27.5-year period. For a commercial property, you can depreciate over 39 years. Hang with me. We're going to throw out some numbers. Hopefully, this will make some sense. Let's say you own a single-family residential investment property. The government allows you to deduct 3.636% per year on the improvement. Now, when I say improvement, I mean the building itself, not the land it sits on. This is a book loss, meaning you're not actually losing money. It is a paper loss on your tax return. Your investment could actually be going up in value. What does this look like? We're going to use some very simple numbers. Let's say you buy a single-family investment property in Omaha, Nebraska for $200,000. Your monthly payment, principal, interest, taxes, and insurance at a 6.5% interest rate, assuming a 20% down payment, is roughly $1,400 a month. You're renting it out for $1,800 a month. So you're making roughly $400 a month positive cash flow. Your tenants are paying your monthly payment, and you're making a little bit of profit each month. It gets better. In a year's time, you made $4,800 in profit. Again, you're going to have some repairs, and there's going to be more deductions. We're trying to keep this simple for the sake of this example. You would think you'd have to pay taxes on that profit you made, right? No, this is where depreciation kicks in. You bought the property for $200,000, and let's assume the home is worth $180,000 and the lot is worth $20,000. The first year, you get to depreciate $6,544.80 on your taxes. On paper, according to the IRS, you actually lost $1,744.80. You get money back because of depreciation. Keep in mind, there's going to be additional losses and deductions that can be written off, and that's why you're going to need the assistance of a tax advisor. We're trying to keep this simple for the sake of this example. It gets even better. The home you bought last year for $200,000 went up in value and is now worth $220,000. Let's say you decide to sell that property after a year. You sell the property for $220,000. You have a gain of over $21,744. You have to pay tax on that, right? No. With a 1031 exchange, you can take that gain of over $21,000 and buy a new investment property for $250,000 and start the process all over again. This is building wealth. On your taxes, the government allows you to show a loss even though your property may be appreciating in value. If you're a real estate investor, one of the people you should have on your team is a tax professional. Remember, if you don't have a tax professional, you are your own tax advisor. It pays to surround yourself with great people on your team, and one of the key members of your team should be a tax advisor. When I purchased my first investment property back in 1991, I was in my early 20s and I was clueless. And when you have rental property, your taxes become much more complicated. And that's why you need a good tax advisor. At the time, my mom had me take my taxes to her tax guy, and lo and behold, I got money back. I didn't understand why. I just thought maybe my mom's tax guy was a little bit shady. I was getting money back, so I didn't want to ask too many questions. And at the time, I didn't understand all the benefits of real estate investing. How did I make money and not pay any taxes on it? Well, when you invest in real estate, there's 4 ways you can make money. Number 1, appreciation. 2, cash flow. 3, equity buildup. And 4 is tax shelter. Many people don't understand the true benefits of real estate investing. All they think about are tenants and toilets, and they don't want to deal with the hassle. And I can understand that. Here's the thing. For every gimme, there's a gotcha. One of the problems when you sell investment property is the government wants to tax you on the gain. It's called a capital gains tax. Now, this is very simplified, meaning the IRS is going to say, hey, all that money you made in profit, we want you to pay taxes on it. So all of the appreciation and the amount depreciated is going to be a gain in the eyes of the IRS. But there's a way out, and it's perfectly legal. It's called a 1031 exchange. You sell the investment property. The gain is held temporarily by a qualified intermediary. This is usually a title company who specializes in 1031 exchanges. When you sell, you have 45 days to identify a new income producing property, and you must close within 180 days. This is for investment property only, and the new property must be worth more than the property you just sold. There are some strict rules governing 1031 exchanges. That's why you want to seek out the guidance of a qualified tax professional and a title company who specializes in 1031 exchanges. Also, the rules are constantly changing, so you need to plan accordingly. Again, if a 1031 exchange is done incorrectly, it could cost you tens of thousands of dollars. You're not avoiding the tax, you're deferring the tax. Investors do this all the time. When you do a 1031 exchange and you purchase that new investment property, you get to restart the depreciation on the new property. Obviously, the purpose of this video is to simply make you aware of what a 1031 exchange is. Again, you want to seek the guidance of a professional tax advisor. If you want to learn more about the buying process, be sure to watch this next video, and you make it a great day.